Hey there, Algo traders. Have you ever thought that your entries might be like everyone else's entries? Well, if so, maybe that's why your results are like everyone else's results. So today I'm going to give you 5 unique, bizarre, unorthodox trading entries that you can use in your own trading. Number 4 will probably blow your socks off. I'm champion trader Kevin Davey, and let's get started. Well, hi there. Today I'm going to talk to you about crazy, bizarre, unorthodox, whatever you want to call them, just different algo entries. These are things that most people just overlook and never do. So let's get started. So first I'm going to tell you why. Why should you use these? Why not just use the simple ones everyone uses? And then I'll give you some definitions of what are unorthodox entries and then where to find them. I'll give you some real world examples and then I'll wrap up with giving you specific steps to use in your trading. So hang on. So the big thing is why? Why would you do this? Well, here's a simple moving average crossover type system. Lots of people do this. The problem is so many people do it. Maybe it worked 20 years ago or 30 years ago, but now it doesn't really work. It just loses money. So what a lot of people do is just take standard things that they've read about or seen in a book or heard on the internet, and then they just go and trade them without really testing them. And they might not even work anymore. But chances are, if it's a standard thing that's been around for a while, it's probably not going to work very well. And when you use one of those things, you'll become one of those 9 out of 10 or 95 out of 100, whatever the statistic is. You'll be one of those losing traders, because most people are. And I think at least part of it is because they're using entries that everyone else is using. And so they get in the market when everyone else gets in, and that's when usually the smart people are getting out, or the smart people at least know that the masses are getting in, and they take advantage of it. So you got to watch out for those standard entries. So what you have to do is you just have to kind of imagine yourself developing good strategies. That's the first step. And using unorthodox entries is one way to get some of those good strategies. But then, of course, you have to test them properly. You can't just take them and just start trading them. That would be foolish, right? But a lot of people do that. It's amazing. And then once you've tested them properly, you have confidence in them, and you go and trade them fearlessly. I've seen so many traders out there who have decent systems who just can't trade them. They don't have the confidence that, oh, this system is real and it's not going to break down tomorrow. So you have to be able to trade it fearlessly. So all 3 of those things kind of combine together. And the way I kind of look at it, they're all kind of steps on that ladder, that stairway to success. Trading is something you have to work at, and especially algo trading. You got to keep developing systems, you got to keep testing, and then eventually, once you get some good things, you can actually trade fearlessly. So try to imagine yourself being able to take some of these unorthodox entries and build something unique and something sustainable. If you do that, then you're on the right track to success. Okay, so what are unorthodox entries? What are these bizarre entries I'm talking about? Well, when you look at it real simply, it's just an entry which is used by few, if any, people. They could be modifications of traditional entries. So instead of a moving average crossover, you do something unique to it. It could be a totally new indicator or a new pattern or something that's not out there that everybody knows about. Everybody knows about like the basic candlesticks. So maybe you add something to them and modify them. And then, of course, you can also get data from other sources. Now, for a retail trader, that might be a little tough, but I know professionals, for example, they'll actually use satellite images of parking lots at shopping malls, and that will help tell them which stores are doing well and which stores are not. So that's pretty unorthodox. Now, like I said, as a retail trader, you probably can't do that, but there are things you can do that are unique. Okay, so let's just modify a traditional entry. What does that mean? Well, a moving average. Take a moving average. It has a certain number of bars that you look back on the moving average, right? You say, hey, this is a 10-bar moving average, or this is a 15-bar moving average. And then you use that throughout the whole back test. Well, one way you can make it unique is make that look back period based on volatility. That might work. So maybe in more volatile times, you want a longer look back length or a shorter look back length. There's pros and cons to both, and arguments can be made for both, but the point is it isn't a set value throughout the whole test. You actually vary it, and you base it on market price action. That could work. Or, another example could be with the RSI. Everybody uses like the 80-20 or the 30-70 for overbought, oversold with the RSI. Well, maybe you make it something that changes with time. Again, it could be based on volatility. It could be based on overall price action. There's a lot of different ways to do it, but the point is it would not be a standard indicator anymore. It would be something unique. And that's kind of what you're looking for. And why? Why look for something unique? Well, maybe your moving average with this variable length gets into the market a day or two or a bar or two before most other traders. Well, hey, that might be a good thing. Or maybe you exit a few days before or after when everyone else does. There could be a lot of benefit in doing things differently than the masses. So that's one way you could do it with these traditional indicators and entries, and you just modify them. And again, the point is you're going to be doing something that very few other people are likely to do. Now, you could create brand new indicators, brand new patterns. Maybe you can look at charts and see different patterns that no one else sees. Maybe you can't. I can't. I know I can't because I've tried. But I know there's people out there who look at charts and say, oh yeah, look at this pattern. And I'll be, whoa, what are you doing? I've never seen that before. So you could do that. You could also modify typical candlesticks and that type of thing. And again, the point is you're doing something unique. That's where the power in these entries are. And then finally, you can also use outside data. So most people, if they're trading a crude oil system, will base their signals off the price of crude oil, right? Makes sense. Well, maybe there's some other data that you can get into. And in a minute, I'm going to show you two examples. And number 4 and number 5 both use some data from outside sources. So data that isn't the price of the instrument that you're trading. So that makes it kind of unique. You could use moon phases, for example. I know people who've done that and have had successful systems with it, believe it or not. A lot of different things. And again, the point is you want to do something differently than everyone else. And that's the whole point of doing these bizarre entries. Okay, so where do you find them? They're all over the place. And sometimes the stranger the location, the better off it might be for you. You can look in books and magazines. You can have coding mistakes. I've actually had mistakes where instead of a greater than, I've had a less than, which made the whole entry completely bizarre, but it worked, so I used it. You can have dreams. I've had dreams in the middle of the night of, oh man, this would be a really cool entry, and it's totally wacky. And if I remember it by the time I wake up, which usually I don't, but if I do, then I go and test it. So you just have to be open to finding all kinds of things. And the key thing here is you can't judge and say, oh, this is not going to be a good idea. You go and test it and let the testing tell you. That's the real key. You don't dismiss anything until you test it. So where to find them? They're all over the place. So let's look at some examples. Now these are all ones that I've used or currently use in real money accounts. So these aren't just pie in the sky kind of fake things. These are all things I've either used or still use today. And what I'm going to do for each one of these is kind of give you a little description. A lot of times I'll talk about how I got the idea, give you some performance, talk about maybe some of the cons and disadvantages, and I'll also sometimes throw in some of the code that I use to develop it, or at least give you an idea how you can create the code yourself. And when I show you the code, I'll be using TradeStation for that. And of course, since I'm going to be showing some results, treat all the performance numbers as hypothetical. Pretty simple. Okay, so the first one, this was kind of interesting because I was listening to a radio commercial one time driving home back when I used to be in the working world, and it was in fall in September, and it said, hey, you got to buy heating oil because the cold weather's coming. And it was marketed for all new traders. So that got me to thinking, well, hey, if they're telling new traders to buy heating oil, probably the best thing to do is actually to sell it short around this period. So what makes this one unique is I do the opposite of what a lot of people are thinking. So for example, in fall, with heating oil, you're thinking about the cold weather. Well, this might be time to sell heating oil, not buy it. And maybe 6 months from now, when it's spring, people aren't really thinking about heating oil, right? Maybe that's the time to buy it. Another example is orange juice. Everybody is scared of orange juice and the crop freezing in January and February. And so that puts a price premium on orange juice, and everybody's real skittish and worried about the price going up. Maybe that's the time to sell short. And maybe the time to buy orange juice is in the middle of summer when people aren't thinking about it. So again, it's thinking about certain markets and thinking about what most people would accept as common sense or traditional wisdom type thing, and doing the opposite. Here's how that kind of worked out. I've traded this for, I want to say, about 10 years now. And it definitely goes through some downtimes and has drawdowns. Any real system will. There's no system that's just a straight line up unless you put your money in the bank. That's a straight line. You earn interest every day. You don't earn much, but it never goes down, right? Well, trading, you're going to have drawdowns. So this is a pretty decent type system. This is the performance of the last couple of years over a variety of different markets, but it gives you an idea that it can be profitable. So here's a code example. And so what I'm doing here is I'm buying on the third day of the month. So it's not a calendar day, it's just the third day. And there's the code to actually execute that. You make sure that today's date, the month, is the same as yesterday's, and compared to 2 days ago, it's different. So if you think about the last day of the month compared to the second day of the month, that condition is going to be true, and it's going to tell you to buy the next bar, which would be the third day of the month. So you can change those numbers around and enter on different days, but that kind of gives you an idea of how that one would work. Okay, so that's number one. What about number two? Number two is something called calendar spreads. Now, a lot of people just don't do this. Professional traders do it. They do it all the time, but a lot of retail traders don't. And let's say you wanted to be in natural gas. Well, instead of being exposed to natural gas outright, buying it or selling it short, you trade a calendar spread. And I use this because a lot of professionals use it, and it has lower margins, usually has reduced risk, and that's why there's a lower margin. But there's also a potential for big moves. So the way this works is you buy 1 month and you sell another month. So here's an example. This is a current trade that I'm doing right now where I bought May natural gas and I sold February natural gas. And you can see the bottom line is actually the equity from buying one May contract and at the same time selling short one February contract. So I'm long and I'm short. It's just different calendar months. And sometimes the calendar months will act differently because of supply and demand. And, with natural gas, it would be warehouse pipeline storage and, those kind of things. So this one in less than a month this spread has actually gone up almost $2,700 per contract. And that's pretty significant. And all the exchanges have quoted spreads to help you with this. So you don't have to leg in and buy May and then sell short in February. You can actually buy May and sell short at the same time. And they actually have quoted prices for that. So it's a neat little world that a lot of people just don't even realize exists. But here's an example of how this can help you. So when you buy May and sell February, like I said, it's almost $2,700 profit. The margin on that was only $1,600, so your return on margin is 160%. Now you could have just bought May and you'd be losing money, or maybe you were really smart and said, hey, I'm going to sell February. You'd be up more money in the same period of time, but the return on margin is less because the outright position requires more margin because there's more risk involved. So this is a nice way to reduce your risk, reduce your margin, and still potentially get some big moves. So there's a lot of professionals out there who trade nothing but spreads. And now it's not easy to do because it's not easy to test these things, but you can have a lot of success with it. So here's an example. This is a strategy that I'm trading over a variety of different markets, and they're all spreads. And you can see the performance since 2019 has been pretty good. This is per contract with costs added in, but it also had a significant flat to down period in probably September to March of 2020. So again, it's kind of neat and it does make money, but it's not perfect. And there is nothing that's perfect. So realize even with these unorthodox entries, things aren't always perfect. So as I mentioned, the disadvantages to this, it's not easy to develop these kind of strategies, these spread strategies, because you're looking at 2 different calendar months, so you can't really use continuous contracts that you'd use if you were testing outright futures. So one thing I rely on, there's a website called MRCI, it's More Research Center, and they actually do some statistical analysis of seasonality with spreads, and they give you when to get in, when to get out. Now I kind of take what they've done and I've modified it and I've kind of tested it on my own. But that might be a good place for you to start. And there's other places too where you can get this spread information. So it's kind of a neat way to do something that not everybody's doing. And you might have to test it a little differently than normal. So, for example, for people who follow the way I do testing, You'd have to do some unique things that you don't normally do, but you can still back test these. Okay, if you've liked what I've said so far, please give it a thumbs up. Let me know what you're thinking. And subscribe to this channel, leave a comment. And if you want a free algo system of your own, just go to my website, enter your information. I don't spam you or anything like that, but you get a lot of good trading information. So again, like, subscribe, do it now. Thanks. Okay, number 3, it's based on game theory. And, if you've ever played a game with your friends when you were little, if you push me down, I'll push you down. A game called tit for tat. You get back at somebody the same way they got at you. So if they don't touch you, you don't touch them. That kind of thing. Well, you can apply this kind of thing to the market. So way back when, I read a book on game theory, and I thought, oh, hey, this would be kind of neat to apply to the markets. So you might say, well, what is game theory? Here's a cool example of it. You've got 2 prisoners, right? The 2 people you're arrested for a crime, and you want to get them to confess, and you want to put this case and solve this case. You're a police detective, let's say. So you put each person in a separate room and you start interrogating them, and you offer them a deal. And you say, hey, if you confess, you might only get a certain amount of time, but hey, don't forget your buddy might confess, and if he confesses and says you were involved and you don't confess, you're going to be in big trouble. So you can either, as a prisoner, remain silent or confess. And depending on what the other prisoner does, your buddy that you committed this crime with, depending on what he does, you get all these different outcomes of potential prison sentences. Okay, so what do? That's the whole idea behind game theory. So all I did was just took this general idea of game theory, applied it to the market. And here's an example. I don't trade this system right now, but you can see it had some real good performance both in development, which was walk forward testing, and then also continued on with real time, really good performance. And it was just based on following the market's direction. So if the market, the last bar, was an up close and I'm losing money on my position, well, then I switch and go long. So it's kind of that tit for tat type game where, hey, the market is going up, so therefore I should be long. And if I had a profit that was in profit, I'd stay in the current position. So it's kind of a little take on game theory. It's not very sophisticated, but it tended to work pretty well. Okay, number 4. Now we're starting to get to some more complicated things. This one, let's say you're trading crude oil. Okay, well, you could just trade crude oil, or you could use the price of other instruments to help you trade crude oil. So for example, you could use heating oil and unleaded gas and use those prices with crude oil to help you get signals in crude oil. So this isn't a new idea or something really bizarre. There's something called the crack spread, which is a mathematical formula. You can look it up, where the price of crude oil, the price of heating oil, and the price of unleaded gas are somewhat all related, because when you take crude oil and you refine it, or actually, the big oil companies refine it. You're not refining this in your backyard, right? But when you refine crude oil, it goes into a lot of different products. And depending how you do it and all those things, you can calculate the theoretical prices of some of these components. And that's all this kind of does. So this complex signal can help you to trade crude oil. And so this is actually a strategy I actually still trade today. You can see when I developed it, I used the data that's in the white. That was my walk forward optimization. Looks pretty good. And then I've been live since, I want to say 2012 with this system. So this system I developed almost 8 or 9 years ago. And you can see it still has some downtime and has some big drawdowns, but over time, it's done pretty well. It's made some decent money over that, 8-year period or so. So it works. And if you look at the code, this is just kind of pseudo code because I'm not describing exactly what I'm doing, but you basically have different data streams. You have one data stream for unleaded gas, one for heating oil, one for crude oil. And you mathematically put those together with some conversions, and you get a value that's called value 1 here. And basically then you manipulate value 1 to get your signals for crude oil. So what makes this really cool and really unique is that you're not just taking crude oil's price to calculate your crude oil signals. No, you're taking the price of heating oil, unleaded gas, and crude oil, and you're manipulating those to get your signals. And when you think about unique entries, bizarre entries, whatever you want to call them, I can guarantee you that 90% of people out there are not doing this type of thing. What the 90% are doing are taking crude oil price and creating signals based off of it, off of whatever, moving averages, and RSI and ADX, all this stuff. So you're doing something unique here, and that's where the value is. Okay, so we've got one more to look at. This is kind of unique because it uses data that you have to get from an outside source. So over the years, there have been studies that say, hey, when Congress is in session, when the US Congress is in session, stocks tend to go down. And the idea is, or the theory, I guess, is when Congress is in session, what are they doing? They're making laws. And what are laws? They're restrictions on activity, right? And so if you think about it, laws a lot of times are bad for business because they're restricting businesses. And if you don't think the government can restrict business, just look anywhere in the world over this COVID-19 when they shut down bars and restaurants overnight. And you think these businesses and these workers didn't suffer? They sure did. Now, what was interesting is the stock market overall suffered for a little bit and then took off. But the point is, government interaction and intervention can really affect businesses. And so the theory here was, hey, when Congress is in session, that's usually not good for stocks. So I took that idea, twisted it around, added to it, did some stuff, and came up with a decent system. Now, the bad part was it had to be updated every day. I had to go to a website. Was Congress in session yesterday? Oh, they were. Okay, well then, I got to mark that down and re-verify my strategy. So that was one con. And then the other con is the last few years have just been crazy. Congress and the White House have just made decisions and passed laws and stuff that have really just helped the stock market. So maybe this doesn't really hold up as much anymore as it used to. But maybe with the change in president, maybe this will come into vogue again. And again, it will be something where Congress passes laws and it tends not to be good for the stock market. So this might be one to kind of hold in your back pocket and then see how it performs. So here's how the performance was with the last couple of years basically just being long. And you can see it was doing good for a while, but it also has some really bad drawdowns. And the really terrible one off to the right is when all the COVID-19 started in March or April of 2020. It recovered from it, but hey, that was a huge drawdown. And I know a lot of us had to suffer through that just being in the stock market in general. But that gives you an idea of how it works. So the pseudocode, just the general description, hey, if Congress is in session, just be flat. Otherwise, be long. And again, with the last presidency, maybe that was it, maybe it was Congress or a combination. This effect kind of just has disappeared for the last 3 years or so. Now, it doesn't mean it's gone forever, could come back. So keep an eye out for this one. Okay, so those are 5 that are pretty bizarre entries, unorthodox entries to me. You know, what do I consider bizarre? Well, I gave you some good examples. I gave you the idea from the radio commercial. Not many people would think of a trading system based on something they heard on the radio. The second one were spread trades. That's a market niche that a lot of people just ignore and don't even know about. So there might be something there. Then another one was using game theory, something outside of normal trading type thinking. That's game theory. The fourth one was not basing signals off the actual price of what you're trading, but trying to use some complicated signals. So I use gold, or you could use gold. I use crude oil, heating oil, and unleaded gas, but maybe you could use gold, US Treasury bonds, and soybeans to do the stock market. Who knows? You have to try these things. But the point is, you're using something a little more complicated instead of just price. And then the last one, I took data completely outside of normal financial data. It was when Congress was in session and when they weren't. And I used that to develop a strategy. That's pretty unique. Not a lot of people do that. So that's kind of what I mean when I say, hey, some bizarre entries. These are things that most people are not doing. And I think that's what makes them worthwhile. So, to wrap up, what are some steps for your own trading? How can you use this in your algo trading? Well, always think about making something unorthodox or bizarre. Don't go with the same old, same old. Try to use something a little bit unique. And then keep your mind open. If your mind's open, you'll be amazed at some of the things that might pop into your brain of things you could trade and ways you could trade. The key is you're going to test it anyway, so don't just dismiss it out of hand. Let the data tell you if it's good or bad. And your brain is probably the best source of ideas. You know, you think differently than everybody else on the planet. So maybe you could come up with some things other people haven't. And again, I've mentioned it a few times, but test and verify everything. You know, the crazy idea might work. What's really crazy is thinking ideas won't work before you even test them. Once you test them and you know they're no good, hey, okay, well, at least you know now. But you got to test. And again, maybe sometimes the logical, the common sense things that everybody's thinking, you know, the standard way of thinking, maybe it doesn't work all the time. So those are some steps you can take in your own trading to incorporate unorthodox entries. Give it a shot. Let me know how it goes. Put a comment. Let me know. What kind of unorthodox things are you using? Hit the like button. Hit the subscribe button. I'm Kevin Davey. Thanks for watching.